Okay, class, this is going to be the second video for this week, talking about the cash flow statement. And what I did was I've developed a 1-year cash flow statement. It's just a very hypothetical, very rough, and cash flow statement. But there is one thing that I'd like to mention that I didn't mention on the last video that can be very important. Whenever you look at these cash flow statements, or you look at any financial statement, whether it be cash flow, balance sheet, income statement, they all are titled in certain ways. Such as the cash flow statement, it typically is labeled like this. It'll have cash flow statement written on top, the company, corporation, firm's name. So for here, we're going to use a hypothetical farm called Casper Farm. And they generally have something that looks like this, or it might just have it'll say year ending and then a date. So for what this means is, it says FY means fiscal year ending 31 December 2016, meaning that this cash flow statement is for the fiscal year that ends on December 31st, 2016. Basically, what this last little line is saying is, when is this cash flow statement for? Well, this one is for the year 2016 ending on December 31st. So, now we're going to get into kind of how do you program, how do you set something like this up in Excel? Where do you put certain things? How does it need to be set up? Well, as you can see, we've got the same three main things. We have cash flow from operating activities, investing activities, financial activities. Down here we have net increase in cash, beginning cash, ending cash. We have one additional thing, says needed for 2017 operating loan, and we'll talk about that here in a little bit. So, as we talked about in the last video, operating activities, what did you receive receipts on? So let's say that Casper Farms, they deal with two main crops. So they only produce two different crops. They produce corn and cotton. So corn produced 100,000, cotton produced 75,000. So what is the total receipts? Well, the total receipts for the operating activities would be equal to the revenue from the corn plus the revenue from the cotton. So that is the total amount of receipts that you received from the products that you sold. Well, how much did it cost you in operating activities? What did it cost you to make that stuff? Say you have one person working for you and you pay him $45,000 a year. That's your labor. How much did seed cost? Fuel cost, fertilizer, income tax, interest expense. Well, here I left interest expense blank. And we're actually going to come up here and we're going to highlight this and we're going to set it, and the reason I'm highlighting it is because I'm going to say I want to come back to it later. But these are all the expenses that go into actually the operation of the place. What are the expenses that are going in other than, say, asset expenses? So we add up the total operating expenses. So we simply come in here and say equals this plus this, plus this, plus this. Just add all of those up to where we say, okay, well, operating expenses are roughly $62,600. Now, we want to get the net cash flow for operating activities. Well, if we remember back to the last video, we said that we wanted to say the total receipts, so we say equal total receipts from operating activities minus the total expenses from operating activities. Notice that this one right here, this interest expense is blank. We're actually going to come back to that just a little bit later. That's going to be your interest expense on, say, your operating loan. So, let's talk about the investing activities. Remember, investing activities, revenue from investing activities are any revenue that you received off of assets. They could be the sale of certain assets. They could be the sale of stocks. It could be the sale of equipment. It could be the sale of different types of assets. So, if you're a farm, and you sell a combine. Well, what is a combine? A combine is a piece of equipment used in farming activities, but it's also an asset. So just like bulls and breeding livestock on a ranch would be considered an asset, tractors and equipment are considered assets in a farm, and even on a ranch for that matter. So what about stocks, the sale of stocks? Sorry, I should be saying stocks sold. So say you sell a combine for $25,000 and then you sell stocks for say $500. Well, that's revenue coming in. Those are receipts that are coming in off the sale of assets. So what we're going to do is we're going to come down here, we're going to add up the total amount of assets, which is equal to this number plus this number. So we have a total amount of receipts from investing activities. So we come down here, now we're talking about expenses under investing activities. Expenses are going to be dealing with the purchase or the acquiring of any kind of asset. So if you're leasing land, that would be an expense, but you're not really acquiring that asset, or you're buying the right to use it. So if you're leasing land or something like that, that's actually going to be in operating activities because you don't own the land. That's not really an asset of yours. You just have the right to use it. Whereas if you buy land, you actually go out and buy this land. Now it's an asset of yours. It's increasing your total wealth. Same as equipment. If you go out and buy equipment, then that's increasing your total wealth. That's increasing, you now are going to own that asset to where that is going to be an asset of yours under investing activities. If you went out and leased equipment, or if you leased land, or if you're paying somebody else to use something, then that's going to be operating expenses. But if you're buying something and it's an asset and you're going to own it, that's whenever it comes into this investing activities. So land payment, you bought this land, you paid $25,000 this year. Tractor payment is $5,000 and you're going to own this tractor, so that's going to be a investing activities expense. And then equipment repairs. So another investing activity expense is the upkeep and the maintenance of assets. So if you have a piece of property and you want to go out and build a barn, or you want to repair a barn, or make improvements to this land, that's an asset, and that's an asset expense under investing activities. If you have a tractor and it breaks down and you have to spend, say, $500 in parts and labor to fix it, that is an equipment repair. You're repairing assets. That goes under investing activities. Anytime that you're providing upkeep and maintenance on these assets, that's going into investing activities. So the total expenses for investing activities is going to be equal to the sum of the expenses for under these investing activities. So we're going to go ahead and add up all of these. And then we come down here and we say, all right, well, what is the net cash flow for investing activities? Well, if you remember back to the last video, it's equal to the total receipts minus the expenses. You notice we have a negative $12,000 here. It's okay to have a net cash flow of negative on this assignment. So, the next thing I want to talk about is cash flow for investing activities. I'm going to move this up real quick. Maybe I'm not. So, if we talked about it, financial activities, did you have to acquire, say, an operating loan, or did you have to acquire a loan to remain in business? So, the revenue under financial activities would be, did you have to acquire this loan for this year, and if you did, how much? So, let's say in 2016, we did not need an operating loan. So we didn't borrow a loan, we didn't receive any money, and we have a revenue of $0 from operating loans, from financing something. that would actually go right here. So your total revenue from that would be equal to the sum of the amount of money that you received in loans, in operating loans, for this particular example. Total expenses, well, how much did you have to take out a loan, say, last year? If you did, you're going to have to pay it back. How much are you going to have to pay back? What is your expense of paying back this particular loan? So say you borrowed about $10,000 in 2015. Well, now you have to pay it back. So that's going to be equal to, your total expenses is going to be equal to the amount that you had to pay back. But there's a second part of this. You had to pay interest on this loan, correct? So say this loan was taken out for 1 year at 5% interest. So where does that interest expense go? Well, it goes back up here in this box that we left blank before. So your interest expense, so we're going to make this simple, and it's going to be, your interest expense is going to be the amount that you borrowed times the interest rate. So we're taking this as a 1-year loan compounded annually at a 5% interest rate, just to keep it simple. So what you're going to do is you're going to come in here under this interest expense box. You're going to say equals to the amount that you had to take out on a loan in 2015 times the interest rate. So the interest rate is 5%. So you had to pay $500 in interest off this loan. Now we can fill in that box, and now that it's filled in, we want to come in here and unhighlight it, saying that we're done with that. So the net cash flow from financing activities, as we did in all the other ones, is equal to the revenue minus the expenses. Again, we're going to have a negative right here. That's okay. So net increase in cash. The net increase in cash is going to be equal to the net cash flow from operating activities plus the net cash flow from investing activities plus the net cash flow from financing activities. Here, we got to say a net increase in cash of $89,000, not $89,900. Pretty good year. So let's say that your ending cash, or now to calculate your ending cash is equal to increase in cash plus your beginning cash. So that at the end of this year, you have $139,900. That's a very simple way of creating a cash flow statement. The next thing I'm going to talk about, and I hope I have enough time, is to determine whether or not you need your need for an operating loan. So let's say, for example, you want to make sure that you always have at least $50,000 in the bank. But, you know, this year is a pretty bad year. Your corn didn't really come in all that well. You only received $50,000 in corn and say $35,000 in, sorry, that's supposed to be $35,000. Still got one number off. Say you want to receive $35,000, and now if we come down here, we figure out, well, maybe your labor or your seed actually cost more like $9,000. Your fertilizer bill was more closer to $15,000. Just throwing in some random numbers. And if we come down here, now we have the ending cash is less than $50,000. But you want to always have $50,000 in the bank. So what are you going to do? You're going to have to take out a loan. Well, how much of a loan do you need? What does this need for the 2017 operating loan? Well, we're going to cover that in the next video.